Welcome to Guides and Tutorials. This is Mark, and I'll be your narrator for this learning experience. We hope it has a positive impact. Now let's begin. We spot Tech Titan CRCL and are convinced it's about to skyrocket. The alert says buy rated and buy the stock. But what if you want more and are working with less capital? Enter call options. A call option is like a ticket. You pay a small fee now for the right, not the obligation, to buy the stock at a set price later. If the stock soars, your ticket's value explodes. If not, your loss is limited to the ticket price. Let's say CRCL is $100 a share. Instead of buying 100 shares for $10,000, you buy a call option for a few $100, giving you the right to buy at $105 within 2 months. You control a big position with a fraction of the cash, amplifying your gains, limiting your risk. But what makes one option cost $200 and another $2,000? It's not random. The price or premium is a mix of several factors. Understanding these is the difference between a smart bet and burning cash. So what are these ingredients? Let's break it down. First, the stock's current price. Second, the strike price. Third, time until expiration. And a few more. Let's dive in. The first ingredient is the stock's current price. If CRCL trades at $100 and your option lets you buy at $90, that's valuable. As the stock price rises, your call option's premium rises too. Next is the strike price, the price you can buy the stock at. Lower strikes are more valuable. Higher strikes are cheaper because they're less likely to pay off. Then comes time. More time until expiration means more chances for the stock to move, so longer dated options cost more. As expiration nears, time value melts away. Volatility is the wild card. The more a stock swings, the pricier its options. Big moves mean big potential. Interest rates and dividends also play a role. Higher rates make calls a bit pricier, while upcoming dividends make them cheaper. All these factors blend together to set the option's price. So, when you see an option's premium, you're looking at a recipe of price, strike, time, volatility, rates, and dividends. Each ingredient changes the flavor and the risk. Understanding this mix is key to smart trading. Ready to see what's inside that premium? Let's break it down further. Every option premium has two parts: intrinsic value and time value. Intrinsic value is what the option's worth right now. Stock price minus strike price, if positive. If CRCL trades at $108 and your strike is $100, the intrinsic value is $8 per share. If the stock's below the strike, intrinsic value is 0. Time value is everything else, the extra you pay for the chance the stock moves more before expiration. For example, if the option trades at $11 with $8 intrinsic value, the remaining $3 is time value. Time value decays every day. This is time decay, or theta. The closer you get to expiration, the less time value remains. Out-of-the-money options lose all time value at expiration. That's why options are a race against the clock. You can't just buy and hold forever. Time is always working against you. The key is knowing what you're paying for, real value or just hope. Next, let's see how the pros price these contracts. It's not guesswork, it's science. Let's look at the model. Wall Street uses the black holes model, a Nobel Prize-winning formula, to price options. It's a sophisticated calculator that takes the stock price, strike price, time to expiration, interest rates, and expected volatility. The trickiest part? Volatility. It's a forecast, not a fact. The model spits out a fair value for the option, giving traders a baseline. It brings order to the chaos, letting everyone, from hedge funds to home traders, speak the same language. But it's not a crystal ball. Surprise news or market shocks can make its assumptions obsolete in seconds. The black holes model is a starting point, not the final word. Real-world prices are set by supply and demand. The model helps, but the market decides. So how does that work in practice? Let's see what really moves option prices on the trading floor. It's not just math, it's human emotion. Let's talk supply and demand. Theoretical price is one thing, but the real price is set by buyers and sellers. If everyone wants to buy a call option, the price jumps, demand rules. If everyone's selling, the price drops, supply takes over. News, rumors, and market mood can send option prices soaring or crashing, far from their fair value. The market is a living, breathing auction, driven by fear and greed. You're not trading against a formula, you're trading against other people. That's why psychology matters as much as math. So how do traders manage all these moving parts? They use the Greeks, delta, theta, and vega. Delta measures how much the option price moves with the stock, your gauge for direction. Theta tracks time decay, how much value you lose each day. Vega measures sensitivity to volatility, how much the option price changes as the market gets jumpy. These metrics help you see risk clearly, not just guess. Delta tells you the odds of finishing in the money. Theta warns you how fast your option is melting away. Vega shows how much uncertainty you're buying or selling. The Greeks are your dashboard. Use them to steer clear of trouble. Master them, and you're trading like a pro. Now, let's wrap it up. Pricing a call option isn't magic. It's a blend of math and market psychology. The premium is part real value, part hope, and all about risk versus reward. You pay a small, certain loss for a shot at a big gain. Understanding what drives that price is your edge. We don't just chase cheap options. We look for specific opportunities. Is it real value or just time and hype? Knowledge is power. The more you know, the smarter your trades. Respect the risks, do your homework, and you'll spot both opportunities and traps. One final note on call options. You have the right, not the obligation, to keep the shares at the strike price you paid, adding them to your portfolio and not selling them. Instead, holding them for long-term investments if you so choose. That is why call options are so popular and so profitable. That said, never over-leverage yourself on one play. Spread your portfolio equally around through different strategies via different alerts for maximum success. That's all for now. Thank you for watching and being a valuable part of the trading community. This has been a presentation from NYC Alerts Guides and Tutorials. For now, class is dismissed.